With Fannie Mae hitting the media, it's time to talk about what a lender overlay is. Most people haven't learned about lender overlays until they're denied for the first time when they apply for a mortgage. Lenders have rules or requirements beyond what Fannie Mae, Freddie Mac, or VA have. They're called overlays. So let's say you're in a loan program like FHA, VA, and now Fannie Mae, which says there's no minimum credit score. It sounds amazing, right? But the lender funding that loan might say, well, we're still not going to go below a 580. Why? Because that lender's taking on the risk. They're the ones whose name is on the line if you default. And remember, a credit score is a risk tolerance tool. And just because a program allows something doesn't mean the lender wants to take that level of risk on their books. Overlays exist because investors, insurers, and regulators all look at a lender's performance data. If a lender's portfolio starts showing higher defaults, they lose investor confidence and pricing power. So they build in buffers, minimum scores, stricter debt-to-income ratio limits, more reserve requirements, and tighter approval conditions. It's risk management. It's not meant to be punishment for borrowers. So here's an example. The VA loan technically has no minimum score requirement, but most lenders still want to see a 580 or higher, preferably 620 plus. Not because they don't like veterans, but because the lender has to sell that loan on the secondary market, and buyers want consistent low-risk files. The same goes for this new Fannie Mae update. Removing the 620 from the desktop underwriter doesn't mean you can waltz in with a 500 and easily get approved. Lenders are still applying their overlays. The change just gives them more flexibility to manually approve strong borrowers who just don't fit the traditional mold. So how do you work around the overlays instead of hitting a wall? One, you want to know your lender. Some are stricter, some are more flexible. Brokers can shop your profile across multiple lenders to find the one that fits your situation best. The second thing you want to do is think about what you can control. Overlays or not, the basics still matter. On-time payments, low utilization, stable income, verifiable rental history. Self-report all of the bills you can. These are universal risk reducers. Get your credit file consistent. When a lender sees a stable pattern, not perfection, just consistency, they're more willing to take a chance even under tighter overlays. This is why self-reporting can help. Don't take it personally. A denial from one lender doesn't mean you're unqualified from another. It means that lender's appetite just might not have matched your file. So yes, overlays definitely can be frustrating. But once you understand how lenders think, you can position yourself like a kind of borrower they want to approve.